Have you ever looked at a stock chart and just seen a bunch of random squiggly lines? Well, what if I told you that professional analysts see a story in there? They have a system, a playbook, that helps them make sense of it all. So, let's dive right into that professional framework for analyzing pretty much any stock.
First things first, let's get one thing straight. A real analyst is not a fortune teller. You can forget about the crystal balls. It's way less about predicting the future and so much more about being a detective. See, their job is to sift through all the clues, gather the evidence, and then build a solid, logical case for what is most likely to happen next, all based on how it's behaved in the past.
So what is this method? What's their secret? Well, that's exactly what we're cracking open today. We're going to walk through the exact three-part investigation that the pros use, a process that helps turn all that market chaos into a clear, actionable plan.
Okay, here it is, the core of the playbook. The investigation, it always starts with the clues that are left behind on the price chart. Then you follow the money trail by analyzing the trading volume. And finally, you connect all that data to real-world events by looking at the news. You see? Each step builds on the last one.
All right, let's jump into our first area of investigation. I want you to think of the price chart as the crime scene. It's where the whole story begins. Every single peak, every valley, every sharp move, that's a historical fact. It's a clue to how the stock has behaved under pressure before.
So, an analyst's first tool of the trade is a set of moving averages. You can think of them like filters that cut through all the daily noise to show you the real story, the underlying trend. They're usually looking at 3 different time frames: the short-term 25-day, medium-term 75-day, and the really critical 200-day, which kind of defines the stock's long-term health.
But here's where these averages get really powerful. It's when they interact with each other. You get something called a golden cross, and that's when a shorter-term average moves up above a longer-term one. That can signal the start of a new bullish phase. On the flip side, you have the death cross. And yeah, that can be a pretty potent warning that the bears are starting to take control. You know, beyond just looking at the trend, a good detective has to gauge the mood of the crowd. Are investors getting way too excited, or are they starting to panic? To figure this out, they use a tool called the Relative Strength Index, or RSI. You can basically think of it as a market sentiment meter.
And reading it is actually pretty simple. If it moves above 70, that suggests the stock is overbought, which is a sign of maybe a little too much greed that could lead to a pullback. But if it dips below 30, that suggests it's oversold, a sign that fear might be creating a potential buying opportunity.
The last step in analyzing our crime scene is to map out the key battlegrounds. Support is a price level. It's like a floor where buyers have historically stepped in and propped the price up. Resistance is the ceiling, where sellers have usually taken control and pushed the price back down. These are absolutely crucial strategic levels to know.
Okay, so the scene is all mapped out. We know the trend, we've gauged the mood, and we've identified the key battlegrounds. Now it's time for the next question that every detective asks. Whose footprints are these? And that's where we start to follow the money by analyzing the trading volume.
See, volume is all about conviction. A price move on really low volume, that's just a whisper. But a massive spike in volume? Whoa, that's a shout. It's like a giant footprint telling us that big money just made a really big move. And this shows a really clear cause and effect. These huge volume spikes, they don't just happen in a vacuum. They're almost always tied to a specific catalyst. You know, an earnings report, a new product launch, or some major news that forces everyone to react all at once. And those footprints, they lead us right to the final piece of our evidence, the witness testimony. In the stock market, that testimony comes in the form of news, earnings reports, industry changes, and official company announcements. This is where we find the why behind all the market's moves.
So a professional analyst takes all this information and puts it together. They don't just read the headline. They understand how different types of news usually impact both a stock's price and its trading volume. Like, good earnings often cause a high-volume gap up. A scandal, well, that'll cause a high-volume drop. They're always looking for these patterns.
All right, all the evidence is in. We have examined the chart, we've followed the money, and we have heard the testimony. Now it's time for the final step, building the case.
And this is where the real work happens. See, professionals don't just make one single prediction. They build multiple scenarios by combining all the evidence. So for a bullish case, they're looking for confirmation. Is a golden cross forming right as the RSI is coming out of oversold territory? And is it all confirmed by a high-volume break of resistance? For a bearish case, they're looking for the exact opposite, a death cross combined with an overbought RSI and a volume spike on a break of support. And hey, if the signals conflict, like a bullish chart but really low volume, they build a neutral case, and they just expect the stock to go sideways. This way, they're prepared for any outcome.
But listen, a scenario is just a theory until it's actually proven. That's why every single case needs a trigger. This is a specific price, often a key support or resistance level, that acts like a tripwire. When that price gets hit, it validates one scenario over the others, and it signals that the next move is probably underway.
And this is just as important. A good detective knows when a lead has gone cold. The invalidation point is their line in the sand. If the price crosses that line, the theory is proven wrong. It's a critical, built-in exit strategy that keeps one bad call from turning into a total disaster.
And that brings us to the final verdict. This entire playbook, from the very first clues on the chart to building the final case, it's all a logical, repeatable process for interpreting the market's hidden story.
So here's the final checklist, the heart of the playbook. The key takeaway here isn't about being right 100% of the time, because no one is. It's about having a structured process, just like this one, to help you navigate the market with a clear plan, manage your risk, and make decisions based on logic, not on emotion.
This framework, it isn't some secret that's reserved just for Wall Street. It's a method for anyone to stop seeing just random squiggles and start reading the real story that the market is telling. It transforms you from just a passive observer into an active investigator. So now that you've got the playbook, which story are you going to uncover first?